Hello everybody, welcome to Alpha Action. As the title of this video suggests, don't buy Apple, do this instead. So first off, Apple is a falling knife right now. It's basically already gone down 30%, and here's the thing. You can think it's undervalued, you can say, quote unquote, I'm a long-term investor, I'm in it for the long term, but here's the thing. It could go down another 30% very easily. And there's a statistic out there that says that after the market goes down 20%, on average it takes another 2.5 to 3 years usually for it to recover. But now the market's gone down a lot more than that. It's probably going to take at least a couple of years for it to recover based off that statistic. And so we don't want to have to catch a falling knife and for the next couple of years be in the negative on those paper losses right there. So we want to try to have a long bias on Apple without all the downside risk. So we can buy Apple on the cheap if it does go really, really low, but we don't want to have to catch a falling knife right here. But at the same time, if it starts going up and there's upside momentum, we want to get in. So we want to use options to place a long bias because the problem when you buy stock is that when you buy stock, every dollar that it starts going down, every tick that it goes down, you lose a tick. You lose a dollar every time it goes down. And so every time Apple goes on dollar, if you bought Apple, then you lose a dollar. But when you use options, it's not the same exact thing. So long the 250 calls, June 17, 2022. Short the 300 calls, June 17, 2022. And short the 170 put, June 17, 2022. So why would you do this instead of just buying Apple outright? Well, right here we have a P&L diagram, and as you can see, the zero line means break even. That means that you haven't lost anything, but you haven't made anything. And notice that the zero keeps on going all the way until 170. So you don't actually lose any money unless Apple goes below 170. And so Apple would have to fall another 32% or so from here to actually get to 170. And you are not forced to own Apple until 170, and you are not forced to lose money until it goes below 170. And so as you can see the profit and loss diagram right there, it's flat all the way until 170 because you don't start losing money until 170. And so this is why using options is a lot better. You won't have to buy Apple until it gets to 170. Guess what? If it gets below 170 and you're a quote-unquote long-term investor, you should be happy to buy Apple at that 170 price. Apple would have to drop another 31% to even lose a penny. So even if it goes to 170, you've still broken even. While if you bought Apple stock right here and it goes to 170, you've lost 31%. But if Apple goes to 170 and you do this trade, you don't lose a single penny. It only requires $17,000 worth of capital, but it costs $24,500 to buy 100 shares of Apple. So it costs $17,000 to put this trade on because it's $170 times 100 shares. Each option contract covers 100 shares. But if you want to buy 100 shares of Apple, that'll cost you $24,500. It still has the same upside, and the call debit spread can just be rolled up if you want more profits. And it also provides a small credit. And because it provides a small credit, this trade is positive theta. That means that you make money from the passage of time. And that also means that if the stock stays at the same price, you still make money. And this is a big difference between stocks and options. And that's that stocks are very black and white products. They can go up and you can make money. They can go down and you can lose money. And it's really just a coin flip in the short term. In the short term, over 6 months, over a year, over 2 years, buying stocks is very much of a coin flip in the sense that there's 50% chance that it could go up, 50% chance that it could go down. And so that there's that right there. And then if the price stays the same, you don't make anything in appreciation. And all you do is that you make the dividend, but the dividend is very small. The dividend is only 1% or maybe 2%, but that's not enough compensation. And that might only be the time value of money. And so if the time value of money is 2%, but you make a 2% dividend, then you really didn't make much. And also seeing that inflation is 2% a year. And so that's the big thing right there, is that this trade is also positive theta. And because options are not black and white products, because options are very dynamic products, they can make money no matter if it goes up or even if Apple keeps on going up, this trade is still a winner. And even if the price stays the same, the trade still makes money. And so that's why I like using options rather than using common stock, because with common stock is very black and white. It either goes up or down, and in the short term, over the next 6 months, a year, 2 year, in the short term, buying stocks or shorting stocks is a very black or white thing from a probabilities perspective, in the sense that it's a coin flip. 50% chance something goes up, 50% chance something goes down in the short term. And so using a high probability trade like this, the probability that you lose on this trade is only 20%. And so there's actually a statistical probability out there that you will win, and that is 80%. While with buying stock over the next 2 years, your statistical probability is 50-50. And so would you rather take the 50-50 bet, or the bet where you have a statistical probability of winning, and that statistical probability is 80%? Okay, everybody, thanks for watching. Like, comment, and subscribe. If you haven't ever used options, or you want more of an explanation, just ask questions in the comments section. And if you have any other comments, go ahead, put them inside the comment section. We answer all the questions. And if you don't exactly understand how to use options, but you're saying that you're a long-term Apple investor, but you don't want to have all that risk, but you don't exactly know how to do this, you can go inside the comment section. I'll give you a better explanation as to how, and go more in depth to it, or answer it in a way that a beginner would understand. Another thing that you can do if you don't really understand how to do this is that you can just call up your broker. You can call up someone at TD Ameritrade or Charles Schwab and tell them that you want to place this trade, and they'll go into your account and they'll place this trade for you if you just tell them the strike prices and the expiration. And so you don't really even have to know the full length of how it works. You can just tell your broker to do it. And if you really don't understand, go inside the comment section, ask me. I will answer all the questions. If you like this, please go ahead, give it a like so I can make more videos like this, and I'll understand that you like videos like this. And if you want to see more content like this, you want to see more high probability trades where you're able to have the upside momentum with very little downside risk and actually have a large probability of winning, go ahead and subscribe. Until then, happy investing, happy trading.